Thank you for joining the Culture of Success show. I've got Peter Quinn here today, who is the Senior Vice President at Kidder Matthews, and I am thrilled to have this conversation with him. We're in a crazy time as it relates to real estate, interest rates, Fed hikes, everything that's going on in the market. And Peter brings a wealth of knowledge that's going to lend very, very valuable insights to what we all should be thinking about, what we should be doing, and really where we should be going with our money for those of us that are thinking about investing in the commercial real estate market. Peter, good to see you.
It's great to see you, Chad. And of course, Chad is one of the partners and shareholders of Culture Insurance. It's amazing how much real estate and insurance work together and depend upon each other. I mean, if
Certainly.
we don't have the proper insurances in place, be it errors and omissions to property and casualty, principal insurance, in the event of untimely, all of that stuff is critical to how I conduct my business every day. So I'm really excited about having this conversation today as well.
Peter, that's kind of you. Not most people that talk to me and insurance comes in the conversation are excited about that, but that was kind of you to make such a nice gesture towards me. And there is no shortage of insurance products that I could talk about or sell people on. So we won't go that deep into it, but yeah, that again, thanks for being so kind.
So the markets, as we have been exposed to them over the last year in particular, is certainly 2022. Rising interest rates don't have just an effect on the cost of real estate to build it, to improve it, to finance it. They have a cost on insurance as well. Tell me, because I don't know it, how is the rising interest rate environment affecting your business?
Yeah, and then I'll answer that a little more broadly, but we are in what we would consider to be a hard insurance market, right, across the board. You referenced earlier, there's different policies that you need to purchase and your clients need to purchase. And right now, we are definitely in a hard market, right? And so what that means is that insurance policies that otherwise have been going down year over year, people that are buying these policies, they're starting to see these rates go up, right? And so it really is a supply and demand issue at the root of it. And the idea being that there's a lot of policies that were purchased, right, even during the COVID time, and then these unforeseen losses that occurred, right, which cost the insurance companies tons of money. And so you have players in the insurance market that have moved away from the insurance market, which is depleting that pool of carriers or markets that otherwise used to insure a certain exposure. They're gone now, right? And so now you have a limited quantity of people that will actually look at insuring something that is considered high risk, right? And because it's a limited quantity, they have set their rates accordingly, right? And so you've got what's a true marketplace as it relates to insurance, and it's tough, right? And so we do things to try and mitigate the increases that our clients experience, but it still is a painful time. And coincidentally, I have one of my most recent podcast episodes. I interviewed a gentleman by the name of Scott Addis, who he's been in the insurance market for 30 some odd years, and he's been through a couple hard markets. And so in that podcast, we actually go in deep dive on the hard market and kind of what's going on and what people should or should not be doing. But as a whole, you're experiencing this, I'm sure your clients are experiencing this, which is rates are going up and it's painful.
Some cases they can't get insurance.
It's true.
That's happening at every level. And the reasons that from our perspective that insurance is not obtainable is the geography that the covered person and or asset class is in. California being one of the more difficult states in the United States in which to obtain certain insurances. I live in an area that is quote unquote a fire danger area.
Yep.
And some of our neighbors are not able to get either an insurance policy that completely covers them.
Right.
Cases they haven't been able to get any insurance at all. I know that's solvable, but then you get into what I presume is the private insurance market, and that can get very expensive.
Yeah, there's something called the California Fair Plan, where it's basically where you go when you can't get insurance, and there's other scopes of marketplaces depending on which line of insurance you're talking about. But to your point, right, you may be able to still go get insurance, but the deductibles are going up, the retentions are going up, and the limits and the values are going down, right? But your price is going up as well. So there's no silver lining in that whatsoever, right? And so you're talking specifically about the fire risk hazards that exist in California, which we know they're
Right.
there, right? It's abundantly clear that there's fire risk hazards throughout the state of California, but on the business side of insurance, right? When you have your employment practice liability policy or cyber policy, or there are other policy coming up for renewal, and you're getting retention rate increases that are 100, 200, 300 times higher, and the premium is going up 50, 60, 70%, but the value of your policy or what would be pay out is going down. I'll just use the word. It sucks. It really sucks. I can understand why it's happening, but it doesn't make it any less painful for the people that have to buy those policies. And
No,
we're
it is.
also a consumer of those policies as well, right? I mean,
Right.
our rates as an agency are going up. So anyways, I'm
Yeah,
getting
I
all
mean,
worked up over here, Peter.
it's reality, I feel so much more comfortable when I'm talking with people in business environments like this, who do know what they're doing.
Yeah.
Because the last thing I need to do, and the last thing I want to encourage my clients, be they investors or people looking for real estate in which to operate their business, being led down the wrong path, winding up with nothing, and or in a non-competitive position where they can't even perform on the real estate.
Right.
Very, very difficult stuff.
Yeah. Talk about that a little bit, Peter, or go more in depth in terms of, again, you have a wealth of knowledge and experience, right? About 25 some odd years, right? In commercial real estate specifically, right? We're not aging you by any means, but 25 some odd years, which makes you about 35 right now.
Yeah, right.
Help us understand, in your experience, I know there's been ebbs and flows, but how does the market today look any similar to a market previously? Or is this really unique in where we're at today? And kind of what's going on?
Each recession that I have managed to survive has had its own unique characteristics, and this recession that has not been formally defined apparently is no different. It's going to be unique. It is already unique. The investment side of the marketplace always looks at discontinuity in markets, which is what we're experiencing, to be an opportunity. But the opportunity winds up manifesting itself in different ways with each recession that I have been in. There was a recession 30 years ago in which the savings and loan industry essentially collapsed. They were a major investor and or lender in commercial real estate. And I define commercial real estate in that context as it could be an industrial building that was being built or converted to a different use, or it could have been a housing development. Their overexuberance led to a situation where the Resolution Trust Corporation, the RTC, was formed, and it opened up an enormous opportunity for people with cash.
Okay.
And those people took maximum advantage of that. So fast forward to 2008, we have what has now been termed historically as the Great Recession.
Mm-hmm.
Those of us that went through the RTC period said, this is another opportunity. This is the chance to go make this happen. The difference was, now I'm going to simplify it because it's can be a very long, complex conversation, but simply stated, the characteristics in the marketplace were the same. We had over-leveraged owners and developers of real estate. The difference was, in order to play or to take advantage of that, in 1990 or 1995, it would take $10 or $20 million, and you could be a player. I mean, you could go find things that had real significant upside. In
Okay.
2008, you needed $1 billion. And
You
so it
said
really,
10, $20 million to $1 billion. It's
$1 billion. If you had $1 billion,
a little spread.
then you
Right.
could play.
Wow.
Now,
Wow.
forgetting, the inflation that occurred between 1990 and
Sure.
2008,
Sure.
that's a massive multiple on the economic or the monetary requirements in order to be able to
Yeah.
play in the game.
Peter, when you say play, clarify what you mean by that. Like, what are we talking about as it relates to play the game? Because that is a big spread, 10, 20 mil to $1 billion. What is that getting you? What are you doing with that money?
So you're leveraging your relationships in the financial marketplaces to identify broken assets in portfolios held by banks, insurance companies,
Okay.
high net worth individuals were a smaller part of that. Family offices played a part in both ownership and advantage takers. And you use the relationships to identify targeted opportunities, and then you use this bundle of cash, 20 million in 1990, 1 billion in 2008, and you basically conduct an off-market transaction where you're stripping those damaged assets out of a portfolio at a discount to not their current value, because it's very difficult to state a current value in 2008. Land obviously had value. If you were trying to buy residential land in Las Vegas or Palm Springs and many other markets around the country in 2008, you would have gone through the exercise, done the math, had your consultants give you what the cost to bring that to the property's current condition. So in the case of residential lots, curbs, gutters, sewer, water, power, streets would be in a subdivision, and that subdivision, let's call it 100 lots, was worth nothing. There was no buyer in the marketplace in 2008 that would take that on. That meant that, and I'll use Las Vegas as an example because I did a lot of work out there, a single family lot. This is a typical suburban residential neighborhood, 6 to 10,000 square foot lots. That lot with all of the improvements that were there, everything but the house, had zero value, and it cost $45,000 to produce that lot. So from a snapshot in time, that lot was worth a negative $45,000. The investor was never going to get his money back. And those were times, Chad, where big national home builders like D.R. Horton and KB Homes were walking away from multi-million-dollar deposits so that they would not have to perform on their contracts to purchase, walking away from additional millions of dollars in site improvement costs.
Right. They saw what was coming. They said, let's get out of this now.
Well, they didn't see a way to build out of the problem because there was no buyer financing in the marketplace in 2008, 9, and 10.
Wow.
There's no market for their product. And in cash dependent businesses like home building, you cannot afford to sit around. It is death to that business model. If you sit around and wait for the market to recover, you got to get out of town.
Wow. So that translates to today. How?
Well,
how's
today,
different? What are you seeing? What are you feeling? What are your clients experiencing?
So that discontinuity that happened in 2008 was nationwide. Some areas got hit harder than others. The coasts were not hit as hard as anything interior. If you were 50 miles from the coast, 100 miles from the coast, you were really damaged in 2008. Wow. But there was damage on the coast. I mean, I live a mile and a half from the Pacific Ocean, and our neighborhood took a significant hit short term.
Sure.
Today, there is no dramatic drop off in otherwise healthy marketplaces. There is not the level of overbuilding that occurred. In fact, as you and I know here in San Diego,
Hmm.
we're falling about 20,000 homes or apartments short of meeting the demand in the marketplace. Uh, and so we're not seeing any significant reduction in the value of single family homes. Now, we're early in this process, so I can't
Right.
predict what's going to happen in 2023.
Right.
But what is happening, and you and I are both seeing in the neighborhoods that we live in, is that when the house goes up for sale 3 doors down, it's not getting, 50 offers,
No.
15 of them all cash at over asking price. Now um, there's some logic being instilled into the marketplace because interest rates are high. So there are less
Totally.
people who are going to be qualified for that. Houses are not being snapped up in 15 or 20 days. Buyers are not having to waive home inspections in order to be selected to buy a house. And this is, by the way, from my observation, I'm not a residential real estate person,
Sure. Sure.
but it's an indicator of what's happening in various segments of the community.
Yeah, I think that the writing's on the wall, right? And to your point, I know you're not on the residential side, and neither am I, right? But you see things. And my wife and I, we just went and looked at a house a couple of weeks ago just to see, it was $1 million home, right? And it needed a lot of work, right? And it amazed me that, the realtor that we're working with came back and said they got a cash offer over asking. I was surprised. I'm like, that's still happening.
Yeah.
Wow. So, and again, I could see the opportunity there personally. I wasn't in a place to go do what this person did and buying the house, so good for them. But it is amazing what's happening out there, and I know the stock market is kind of like the leading indicator, and real estate follows suit, right? And so you're seeing the markets just there's turning red, right? There's a lot of red going on, and so you would expect real estate to start seeing some of the same fallout, especially with interest rates going up. I think I had heard that for every 1%, right, the interest rates go up as it relates to financing your home. Like the buyer loses 10% purchasing power, right? So it makes sense that if that's right, by the way, if that's right, it makes sense that, we're seeing values of homes, or at least I'm seeing recently on Zillow and Redfin and some of these other, real estate applications where home values or the offer price or the asking price is going down, 5 to 10%, which is like,
Right.
wow, this is actually happening. It's
Yeah, I
crazy.
don't know exactly what the math is. I had not heard that they lose 10% of their purchasing power, but I did hear yesterday on a national newscast with somebody talking to folks that knew. So interest rates 180 days ago were 3%.
Hmm.
They're almost 7% today. On this home that they were sitting in North Carolina, the mortgage payment 180 days ago would have been 3,400, and today it was going to be 4,100. That's significantly more than 10% more
Right.
expensive. In fact,
Right.
I think it's a little bit over 20%. And if your income did not go up in a corresponding manner, you were not going to qualify for that house that you fell in love with 180 days ago.
Right.
Of course, if you
Right.
weren't an over offer 180 days ago, you weren't getting the house anyway.
Right.
It's super interesting. Uh,
It
and
is.
and we're seeing it, of course, trickle into the commercial marketplace. So
Yeah. Yeah. It's interesting. I would argue personally. So I wouldn't argue. I would just tell you personally, we have felt somewhat insulated, right? Up until probably, I was just having this conversation with my wife just last night. Up until probably the last month or so, like, again, food costs are going up, everything's going up, gas is going up, but we're doing fine. We're doing fine. And it just feels like recently, like hey, sweetie, like let's be mindful. Right? It feels like, you're more middle class moving up citizens in America are starting to feel the effects of what's really happening, right?
Right.
And it is wild. It's very interesting, to use the word you said. And where's it going, right? I think I don't know your perspective. I'd be really curious on where you think this all ends up and kind of timeline, but I don't see this getting any better anytime soon. There's too much drastic changing going on, right? With the Fed rate hikes, right? I'm hearing, we could get another, 1%, right, at the next meeting. That's scary. That's crazy.
It is scary, really scary.
Yeah. With
And,
that, where do you think this is going? I'm just curious. And obviously,
well,
you know,
it's
it's your
there's
opinion,
a
but I'm curious.
there's a local perspective. I'll say take California as our local perspective,
Sure.
and there's
Which
a
is
national
somewhat insulated.
Well, we are insulated in many ways from both some of the good and the bad. The bad news, I think, for Californians is that we have not yet seen the effect of rising costs due to the cost of living that producers, transporters, and retailers are all feeling, in their balance sheets. When gas is $6.50 a gallon, that must mean it's going to be more expensive to deliver that loaf of bread from that
Absolutely.
factory, that warehouse to the grocery store. It must make your Uber ride, your Lyft ride more expensive because that person's not paying $3.50 a gallon, which is the national average.
Right.
They're paying, in some cases, over double that. And that's a self-inflicted wound. That's a wound that Californians have allowed to be inflicted because we basically have a one-party political system here,
Yeah.
and we can't do some things that I think are pretty simple and logical, like let's eliminate the gas tax for some period of time. Don't send a check out to people that quote unquote qualify.
Right.
Let's just eliminate the gas tax. That gives everybody a tax break that they can use every day, and will keep the pile on of costs from overrunning middle class America.
Yeah.
The multimillionaires, the billionaires, they're not happy that that's happening, and
Sure.
of course they're leaving California in big numbers.
Right.
But they're not going to miss a meal. They're not going to not fill up their gas tank. They're not going to miss a mortgage payment.
No, they're seeing this as an opportunity.
Well, some
Right.
some
They've
do,
got the
but
cash on hand to go offer $1 million on a house that needs $200,000 worth of work.
right. Yeah, no, that's no kidding.
You know what I mean? Like they're insulated in a different way than the rest of the world, really. But yeah, it's crazy. I mean, legislation doesn't help, and there's so many things, and it is unfortunate, right? Doesn't matter what party you're in.
No.
If you don't have the ability to have, interactive conversations and push back against one another, like you get one party driving their solution, which isn't a solution.
Right. And
Right?
that as
It's
you say, it
unfortunate.
really doesn't matter what party you're in.
No.
One party rule means there's no conversations taking place.
Right.
And therefore there's no compromise necessary.
Right. That's
And
like if I go
think
tell
that's
my wife how it is and what's going to happen, what we're going to do with our money, how we're going to do things. That stinks, right? She's not going to be happy about that, right? We have a relationship, right? And unfortunately, that relationship doesn't exist in the same way with our state Congress or state legislators. Like it doesn't, which is too bad. So we've talked a little bit about today, where things are today. Where are things going? I mean, what, from your perspective, the clients you're working with, and you just went and visited some space today. What are you seeing? What are people doing with their money? Or what are they talking about doing? I mean, I'm sure opportunities will be created through this cycle, right? Like they always are. But from you, Peter, what are you seeing happen? And what might people want to think about doing who are considering, getting into the commercial real estate space, whether it be by way of purchase or getting a part of a purchasing group? Like, yeah, I would love to get your perspective.
There's an opportunity in every market. There's no, there's no markets that completely get paralyzed. There is a pause that will occur. Hasn't actually occurred here in California. There's still more money that is interested in investing in commercial real estate in California than there are opportunities to invest. It is forcing some syndicators, people who bundle up assets and then syndicate them out to multiple accredited investors. They're spending most of their time outside of places like California because yield or return on investment is much better out of state than it is in California. On the other hand, as I've explained to friends and colleagues and clients, there's no replacing how fast things grow in California. Now, they may grow at a similar rate of growth to, say, New Mexico, but the basis is, I'll use a bad example. The basis is $1,000 in California, and it's $100 in New Mexico. So if we have 10% growth in value, I'm getting a $100 boost in California, and I'm getting a $10 boost in New Mexico. So it's you sort of have to pick your poison. That's why everybody can't play in California, because the cost to play, and I don't mean to use that in a way that's denigrates the importance and value of being very astute about how you're using your money, but it's super real, and I think that gap will continue to exist. All things being equal, we're not in a nuclear war with Russia.
Not yet.
In which case, all bets are off.
Right.
But there's still opportunities. I don't see any dramatic slowdown in opportunities coming to the marketplace, but that will happen.
Do you feel like the forecast shows we're going to slow down even more, or do you feel like we're nearing what could be the bottom of the slowdown, and at some point, sooner than later, we're going to start the upswing? Like,
yeah, I don't think we have seen the bottom. I don't think we're close to the bottom. I think there's going to be significant additional adjustment. Yeah. As you said earlier, the sort of leading indicator is the stock market.
Right.
And that's a very emotional market in which to be an active investor today, and certainly not for everybody. But I'm not so sure how close it resembles what's going on in the balance of the marketplace.
Sure.
And I can't tell you what the balance of the marketplace is going to do.
Right.
But it will be more difficult, I think, in the next few years to find the quality of investments that have been available in the last decade. Yeah.
Yeah. So wild. It's wild how, things play out, and given the economy and where we're currently at with interest rates, and, are you seeing our individuals, and I don't know the answer to this in terms of who you're working with, but are individuals looking to buy commercial real estate currently, or is it really these syndicates of money where people are pulling money together to go buy larger properties, larger investment opportunities? Yeah. What are you seeing most?
Yeah, institutional investors are clearly driving the market.
Okay.
I was with a very successful local investor who invests all over the country, but has been a major player as a private family that invests in companies and real estate. And he recently lost two deals to institutional investors. They just couldn't compete with the rate of return that the institutional investor was willing to accept. So he wanted a 4.5% return, which is now, 2.5 points below the cost to borrow.
Yeah.
And the institutional investor was willing to do a 3.5% return.
Wow.
And that, I believe, though, will start to slow down because institutional investors are guided by the source of funds. And the source of funds are everything from CalPERS to Ohio Stirs. There's the folks that are investing pension fund money from public employees.
Okay.
Their boards are conservative, and they will be telling their institutional investment partners, okay, guys, just hold on for a minute. Let's be careful about what we're doing. Let's make sure that we're all in agreement that we're willing to accept these lower returns, or maybe we just take a pause. If you can invest in T-bills and get a 4% return, I'm not sure why you would want to invest in commercial real estate with a 3% return.
Right. Right. Yeah. Yeah. Unless the opportunity changes and market changes and it becomes more advantageous to do that.
But Chad, how old are your children?
My oldest is 5 and my youngest is 2. And I have
So-
3. So I have a 5, 3, and 2-year-old.
Yeah, so
Can't leave
it's
out that middle
probably
child.
impossible to look at them and go, well, this is how they're going to be affected, because they're really not going to be affected.
Okay.
They're not going to see, any difference in how you guys conduct. Now, maybe we're not eating steak as much. Maybe we're not taking the family out to dinner and brunch as much.
You are not getting that organic applesauce pouch, I tell you what.
But I think that, kids that are in high school and in college, I'll bet that they are seeing some of the effects of that.
Certainly.
I know that people that I know that have kids in high school who are of driving age, they're not getting that newish car that they might have gotten 2 or 3 years ago.
Right.
And it's not necessarily a hybrid or a electric vehicle, but they're certainly going for an economical ride.
Right.
That the kids will not break their own bank on.
Right. Yeah, that's a whole nother conversation. I mean, just, people that are looking to buy new cars today, like, it's one of those things where, like, do I go the full height? Do I go full electric? Is Tesla where I go? Do I go the hybrid? This California is going to discontinue selling, fossil fuel vehicles at some point, right? Is that really going to happen? It's just, that again, another conversation for another day.
It's nuts. Some of the
It's
stuff
nuts.
that's going on.
It's nuts. Yeah. Yeah. And earlier you were talking about just that the cost of goods being transported to be sold and the effects of that and what that's going to feel like. I mean, you said gasoline prices, diesel prices are even more, right? And I mean, those trucks are diesels. It's just mind-boggling. And playing back into the electric vehicle conversation, there's nothing out there right now that will replace, a diesel truck, right? You just can't replace that right now. Love the technology, love where it's going. I think it's awesome. But when you've got Elon Musk saying we need to create more fossil fuel to succeed, right? It's saying something.
Well, he's a logical thinker.
I think so. Yeah.
He's connected the dots.
I hope so. I buy a stock, so hopefully that's
I hope you're doing well
hopefully
with
he's got
that.
it figured out.
Yeah, no, exactly.
If you could take off your real estate hat for a second, just your time in the business world, where do you think there's opportunity, right? I mean, I'm thinking whether it be real estate, getting into real estate or something else, where do you think there's opportunity that exists today, right? Going into the downturn of this market and kind of where it's going to be going. And I know it's a broad question, maybe not even a fair question to ask, but what opportunities exist in your opinion for people who are looking to invest their money? Some ways, like they're sitting on cash. What do I do with this cash? Do we sit and wait? Do we do, what do we do?
Yeah, my estate planning team has really pushed me more to cash. And by that, I mean, uh, reducing the equity portion or the stock portion of our portfolio and taking that money and investing in T-bills.
Hmm.
Not necessarily long-term commitments to T-bills, but and I think that they're actually also suggesting that I leave a little bit higher percentage of my investable capital in the stock market. And I remember years ago hearing Warren Buffett say, I don't invest in anything I don't understand. And
Yeah.
I don't
Yeah.
understand the behavior in markets like this. It's way too volatile, and it's a little scary. So
Sure.
I think people with great ideas are going to continue to create value. Those are companies that I'd like to be an early investor on. And it's not just technology companies. It's not just, the biotechs and the Metas and the Googles and the Facebooks of the world. It is,
Right.
people doing real things with real materials that require, real expertise to profitably bring to the market. I don't think that's going away. I think that we'll see more and more small businesses become, really successful medium-sized businesses. And there are millions of those kinds of businesses, thankfully, in our country.
Certainly. Certainly. Yeah. Going back to your comments, Warren Buffett, don't invest in things that, you don't understand. So what you're really saying, Peter, is that everyone should go out there and buy some cryptocurrency, because that makes a ton of sense to everybody. Of course, I'm kidding. Don't do that. Don't do that unless you fully understand it.
Yeah.
And I
Let
should
me give you
preface,
my
Peter and I, neither
dissertation on
Peter and I
blockchain.
are, yeah, right, blockchain, yeah. But I need to preface this in case people are just listening in. Peter and I, neither of us are financial advisors. So please don't take this advice and go do something with it and then sue us. Or if you do sue us,
past
sue Peter, not
disappointments
Chad.
cannot be construed to create future disappointments.
There you go. There you go. There you go. You got it. Well, Peter, this has been great, man. Short, quick, but wanted to have the conversation with you. Your insight, your wisdom is gold. So I appreciate you taking the time to talk with me. Super insightful. I'll look forward to talking to you again at some point in the future.
We'll see each other all the time, Chad. It's really, really great spending the afternoon with you. And let's make sure that we do get out and have that beer sometime soon.
Beer, golf, anything. Yeah. If you know anyone who's got a yacht or a boat, I'll go out on a boat. Yeah, any one of those. Yeah, that's great. No, Peter, this has been awesome. Thank you so much for taking a Friday afternoon to talk with me.
You bet.
Take care, bud.
Take care.